It is said that money is the root of all evil. In this video on fractional reserve banking, I will attempt to explore the mechanisms of this practice in all its nuances, in the hope that it will give you a better understanding of how the modern financial system operates and why it must be contrasted to a free market system. There are many videos on this topic on the internet, but none of the ones I've come across are quite like this one. Despite my lack of animation skills, you are about to be exposed to a unique perspective. As the saying goes, listen to all, follow none. Banks have two basic functions. The first is to be a safe place to store valuables, whilst the second is to facilitate lenders and borrowers. Appreciating these two distinct functions will help you to understand demand deposits and term deposits. The first function treated the bank as a safe warehouse to store gold and silver bullion. This was usually done by a goldsmith, as they had the infrastructure in place for security. That way you got economies of scale without having to set up a separate establishment. When people deposited their metal with the goldsmith or with the bank, they would get a receipt, and they could at any time hand in the receipt to get the actual metal. It's a similar sort of setup with a dry cleaner. When you take your clothes there, you get a receipt, and then when you come and collect your clothes, you use the receipt as proof of ownership. In a situation like this, where the bank has promised to pay half an ounce of gold to the bearer of the note and has no other notes outstanding, and actually has half an ounce of gold in the vault to be ready to pay on demand, it's said to be running on 100% reserves or have a 100% reserve ratio. This is because the assets that the bank has, which is the gold in the vault, matches the liabilities outstanding, which is the promise to pay that half ounce of gold to the bearer of the note on demand. People used to trade physical metal for goods and services, but over time they started to substitute this with the bank receipts and the promises to pay physical gold and silver on demand. This is just because it's more convenient to carry around the receipt for physical metal as opposed to carrying around metal all the time. They used to compete on how the banknote looked, how durable it was, and they would also compete on the fees that they would charge to warehouse the gold in the vault or the silver in the vault. But what started to happen was that banks realized they could issue more notes than specie they had in the vault. Specie means physical gold or silver. In this example, we'll just pretend that the bank has a 33.33% reserve ratio, so that for every specie coin, there are 3 banknotes. The modern banking system calculates reserves in a different way, and I'll cover this later in the money multiplier effect part, but to keep things visually simple, we will just use this method. The banker would go out and spend this note in exchange for goods or services, and thereby get the note circulating in the economy. This process is inflationary because the bank is creating more currency notes out of nothing, which expands the currency supply, which is the definition of inflation. It also causes prices to be bid up higher than they otherwise would have been, which causes price inflation. There's a catch for the bank, however. Eventually those notes find their way into people who want to redeem their paper note for the physical specie. Now remember, of course, this bank is running on a 33.33% reserve ratio. So if more than 1/3 of the people want to redeem their banknotes for physical specie, the bank won't have enough specie to provide it and will have to default on its obligations. On occasion, members of the public would suspect that the bank is issuing too many notes relative to the amount of specie in the vault, and they would all rush at once to redeem their notes for specie. This is known as a bank run. In a free market, the risk of a bank run means that the bank has to keep its reserve ratios high. There is also another reason why banks have to keep their reserve ratio high in a free market, and it's a phenomenon known as the interbank clearing mechanism. To understand how this works, let's imagine that we've got that original bank where it's issuing 3 times more paper notes than specie it has in the vault. We have this member of the public, and the bank goes out and exchanges some notes for some real goods and services, but this person is a member of a different bank, and he deposits the original banknotes with the new bank. The new bank doesn't just want to hold on to the old bank's banknotes, and there's 2 reasons for this. The first reason is that the original bank might be charging storage fees to hold the specie. So the new bank would like to move the specie into its own vaulting facilities and not be charged the storage fees by the other bank. The second reason the new bank would like to exchange the other bank's notes for actual specie is that the new bank would either like to lend out the specie and charge interest on it, or otherwise use the specie to back up its own notes that it's running fractional reserves on. So the new bank hands in the old bank's notes, and the original bank has to hand over some specie to the new bank. But there's a problem. The original bank doesn't have enough specie to redeem the notes, and has to default on its obligations to pay. Since the original bank can no longer meet its obligations, it is now insolvent. The original bank's banknotes are now worthless, and they disappear from circulation. Banks that have higher reserve ratios are less likely to be affected by the interbank clearing mechanism. If the new bank issues 2 notes for every half-ounce coin it has, it is said to be running on a 50% reserve ratio. This is because it has 2 liabilities for every asset it has. The original bank had issued 3 notes for every half-ounce coin it had. It was running on a 33.33% reserve ratio. This is because for every 3 liabilities the bank had, it had 1 asset. Banks with higher reserve ratios will be much less likely to experience a bank run when the public panics and redeems its banknotes, and it's also much less likely to be affected by the interbank clearing mechanism. As you may have noticed, private banks no longer issue private banknotes. This practice was slowly taken over by the state as legislation was passed whereby only the central bank was able to issue notes redeemable for precious metals. In my long talk entitled "The Financial System is Extremely Unstable," I spoke about the Peel Act, which demonstrates this in the UK for the Bank of England. This was done not for economic reasons, but for ethical ones pertaining to property rights. Multiple people cannot think they have 100% ownership over the same specie coin, just like how a dry cleaner cannot lend out your coat while you've deposited your coat and hold a receipt. Banks could get away with this in the past because specie is fungible, meaning you don't need to receive the same coin you deposited, whereas if the dry cleaner tried to give you a different coat because he'd lent out your one, you'd notice. Once this was legislated out of existence, only the state could run fractional reserves using banknotes. My previous video entitled "Extremely Unstable Financial System in Under 40 Minutes" runs through the US Treasury and central bank's example of this. In that video, you'll get an understanding of how when the American government was on the gold standard, they had to back their notes with 100% reserves. Then after the First World War, they went on a gold exchange standard, or a fake gold standard, where they were able to run 40% reserves, until that ended into the Bretton Woods system, which required the American government to hold no reserves, and then ultimately the fiat system now, where we have no gold at all backing the currency, but rather run on a fiat system with, again, no reserves. What we've discussed so far in this video is fractional reserve for banknotes, which is now illegal for private banks to do, even though governments did the same thing to a worse degree when they issued redeemable notes. You remember at the start of this video I said that banks have 2 basic functions. We've dealt with fractional reserves for the first one, safe place to store valuables. Now we're going to deal with fractional reserve banking in the second function, where banks are to facilitate lenders and borrowers. This type of fractional reserve banking is probably more sneaky than the first type. In the previous example, a bank would issue more paper claims than specie stored in the vault. It would then spend the unbacked banknotes in the real economy in exchange for goods and services. Dealing with the second type of fractional reserve banking, also known as fractional reserve lending, is probably more relevant in the modern economy. Let's imagine that there is a bank and a member of the public wants to store his gold specie in the bank itself. Now, if the person wants access to his gold specie at any given time, it would be a demand deposit because he has the right to request the specie on demand. And as a result of that, he would be treating the bank as a warehouse and he would be paying a storage fee to the bank, as they are providing him with a service of keeping his bullion stored safely. He would be paying the bank a fee and he would not be receiving any interest payments. A member of the public may not want to be able to access their specie on demand, and if that was the case, they would set up a term deposit. A term deposit gives the bank the right to lend out the specie for a fixed period of time, and the depositor is rewarded with interest payments as he's no longer able to access his specie on demand. To keep things simple, we'll say that this bank is paying the depositor 10% per year for storing his savings in the bank in a term deposit. Recall how we said that the second function of a bank is to facilitate lenders and borrowers. So we'll imagine that there is a second member of the public and he would like to borrow some money from the bank. The bank can lend the borrower either the physical specie or, more likely, issue them with a banknote. Now the borrower has to make interest payments to the bank, and for this example we'll just pretend that the borrower has to pay 20% per year. The scenario we've just run through is for a bank that is not practicing fractional reserve lending and therefore has a 100% reserve ratio. The bank is paying the depositor interest of 10% per year, or 0.1 gold ounces per year. The bank is also collecting interest payments from the depositor of 20% per year, or 0.2 ounces per year. For its role of being the intermediary between the lender and the borrower, the bank makes the spread, which is about 10% per year, or in this example, 0.1 gold ounces per year. Now we'll go to a different bank where they're not running on 100% reserves and they're practicing fractional reserve banking, and this bank is running on a reserve ratio of 20%. Remembering, of course, that a bank that is running on fractional reserves, what that means is that for every asset it has multiple liabilities, and then in this example, for every asset the bank has, it has 5 liabilities. Now we'll pretend that this bank also has a borrower who wants to borrow some money from the bank, and the bank lends the money to him, and now this person has borrowed 5 gold ounces from the bank. whilst the bank only has 1 gold ounce on deposit or 1 gold ounce in reserves. Now, because this person has borrowed money from the bank, he has to make interest payments. And we'll stick with our example where the interest repayments are 20% per year, and in this case, it is 1 gold ounce per year in repayments. You can begin to see how when a bank has a lower reserve ratio, it is more profitable, because this bank is charging interest by lending gold it doesn't have. We still have the depositor who placed their gold in the bank in a term deposit, and he's still receiving interest payments of 10% per year or 0.1 ounces per year. So the bank is making a profit of 0.9 ounces per year, as contrasted to when it was running 100% reserves, when the bank was only making a profit of 0.1 ounces per year. Before we move on, let's stick with this example again. So we have the same bank, except this time it's running on a 10% reserve ratio. And it's running on a 10% reserve ratio because it has 10 times more liabilities than it has assets. I am oversimplifying this to get the point across. Fractional reserve lending is a little bit different in the way that it keeps its reserves, as I will show when I discuss the money multiplier, but let's just keep things basic. The bank lends 10 ounces of gold in gold notes to a member of the public who borrows the money, and the borrower is paying interest to the bank of 20% per year, or 2 ounces of gold per year. The bank still has to pay interest to the person who deposited money in the term deposit, and they are paying interest payments of 10% per year, or 0.1 gold ounces per year. Overall, the bank is making a profit of 1.9 ounces per year in this example where the bank is running a 10% reserve ratio. We can see that the bank is much more profitable on a 10% reserve ratio than on a 20% reserve ratio. And when we have a look at them side by side, you can see that the bank on a 10% reserve ratio has double the revenues than the bank with a 20% reserve ratio. So we can see that banks like having a lower reserve ratio, however they run the risk of having a bank run when members of the public realise that there's not enough gold to back the banknotes and they all rush in at once, and the bank does not have enough assets to pay out all the outstanding liabilities on demand. Even though gold and silver specie are no longer used in the modern day economy, the same example we've just run through is still valid, except all you will do is substitute physical cash for the gold bullion. We'll run through an example of this in a moment, and then we'll also add a central bank so you can get an understanding of how central banking skews this system and makes it even more pervasive. Most businesses try and structure their cash flow so that they have their assets flowing in before their liabilities flow out. But because the bank can have any amount of liabilities coming in at once, while only having a certain amount of assets on hand, they really do run the risk of becoming insolvent if the public becomes scared, or they just by chance have too many people redeeming their notes at once. In a free market, there is also the risk that the bank that runs a lower reserve ratio will be challenged by the interbank clearing mechanism, where a bank with a higher reserve ratio will keep on demanding that the bank with the lower reserve ratio exchange its notes for specie. In a free market system, this is what would keep the banks in check. There is a little bit of debate about exactly what a free market system is for this scenario, because some people argue that a bank cannot engage in fractional reserve lending in a free market system because it is a violation of property rights, as multiple entities cannot claim ownership over the same item at the same time. Some free market economists, most famously like Ludwig von Mises, have argued against the government setting the reserve ratio at 100% simply because of the fact they do not trust the government to keep the ratio at 100% and then over time lower it. If the government by law sets the reserve ratio, it is more likely that all banks will be close to that reserve ratio and therefore have less differential between banks that run very, very low reserves against very, very high reserves, and therefore it's less likely that the interbank clearing mechanism will function as it does in a free market where the government isn't setting the reserve ratio at all, or one where the practice of fractional reserve banking is illegal because it violates property rights. My personal thoughts on this, and if I ever was to do a doctoral thesis on this, I would consider free banking in an ANCAP society to function with PDAs selecting appropriate banks to use while still being covered by the defense organizations. Since PDAs have an interest in not paying out claims in the event of a bank run, they would only insure clients' property rights in sound banks chosen by them and audited by them. This would see reserve ratios set at close to 100%, if not 100%, and the PDAs would audit the bank and ensure the term and demand deposits of their clients. Let's imagine that we have a bank and that this bank is running on a 10% reserve ratio. This bank is able to issue 10 liabilities for every asset that it has on. Again, I'm oversimplifying it and this is not strictly correct, but we'll talk about that later. We will also imagine that there is a member of the public who would like to borrow some money from the bank. He borrows 10 ounces of gold from the bank and has to make repayments on this borrowing. The man who borrowed money is a businessman and he uses the money to start a shoe company. There is another bank, and this bank is running on a 20% reserve ratio. It is able to issue 5 liabilities for every asset that it has. This bank lends money to a different businessman, and this new businessman is obliged to make the bank repayments. The new businessman makes shoelaces, and the original shoemaker decides that he would like to use some of his loan to purchase some shoelaces from the shoelace maker. The shoelace maker takes some of the money he's just made and uses it to make a repayment to the bank. The bank takes the banknote and gives it back to the issuing bank in exchange for specie. We discussed earlier the interbank clearing mechanism, and this is an example of this. The bank does not want to keep the other bank's banknote. It would rather have specie so that it can either sell loans against it or use it to buff up its own reserves. The issuing bank then destroys its own banknote until it can find someone to lend it out to again. Paying down debt in a fractional reserve banking system is actually deflationary because when you pay down debt, you are taking currency out of circulation. Deflation can also occur when borrowers default on their debts. Bad economists will conflate monetary deflation with price deflation. They will panic when they see prices falling and therefore fear that we're going to go into a recession, but it's the other way around. A recession actually causes credit to collapse and therefore shrink the currency supply, so they've put the cart before the horse. Eventually, the shoemaker is able to sell his shoe, and in exchange, he receives a banknote. He uses this banknote to repay his bank. His bank then takes this banknote and gives it to the other bank in exchange for physical specie. The other bank then takes its other banknote out of circulation until it can find someone else to lend it to, and we're back to where we started, except the businessmen have made repayments to the bank. In our next example, we'll pretend that the bank with a 10% reserve ratio experiences a bank run. The bank is no longer able to extend credit to the original businessman, and he finds himself in an awkward position where he's no longer able to borrow to finance his business. This presents a problem for the other businessman, as the shoemaker is now no longer able to borrow money to purchase shoelaces from him. Because the businessman cannot sell shoelaces anymore, he is now no longer able to make his repayments to the bank. Now the shoelace maker's bank is in a serious problem because the original bank experienced a bank run. To prevent this situation from even occurring, when the bank sees the other bank beginning to experience a bank run, it will actually lend some of its reserves to the other bank and send some specie to it. That way the original bank will not experience a bank run, and they will be able to lend money to the shoemaker, who can then purchase shoelaces from the other businessman and make his repayment to the bank. The banking industry is fairly unique in this regard. For example, if I owned a bakery and a competing bakery down the road went out of business, that'd be good for me because I'd be able to get some of their customers, I might be able to hire some of their employees, get their equipment, etc. For banks, it's not the same. Due to fractional reserve lending, sounder banks will have to bail out less sound banks. Because the unsound banks know this, it causes a moral hazard whereby unsound banks take greater and greater risks in the knowledge that their sounder counterparts will be forced to bail them out. That is why the banking industry tends to form a cartel through the creation of a central bank. We have our privately owned banks. One is running at a 20% reserve ratio and the other is running at a 10% reserve ratio. The central bank sits above both of these private banks and actually pools their reserves. The reason the central bank centralizes the bank reserves is so that when the less sound bank experiences a bank run, it can institutionalize the lending from the more sound banks to the less sound banks, and thereby negate the effects of a bank run onto the other fractional reserve lending institutions. It is not a market phenomenon, and the central bank acts to discriminate against banks that are not part of the central banking system. Because sound banks are no longer rewarded for their prudence in a bank run situation, as they are forced to lend out their reserves by the lender of last resort, they are no longer prudent and decrease their reserve ratio. The reduction in the reserve ratio leads to more currency being created. When the economist Ludwig von Mises was coming up with his Austrian business cycle theory, he was referring to banks reducing their reserve ratio rather than the central bank printing currency outright. Once the central bank centralized all the reserves, it became apparent that the central bank would then be able to create inflation to the benefit of the banking industry. The way that this was done was by reducing the minimum reserve ratio required for banks part of the central banking system. Member banks were required to hold a minimum percentage of reserves by the central bank to prevent a bank from lending out way too much money due to the moral hazard created by the central bank. This led to a synchronized inflation across the banking industry for member banks, all the while making it very difficult for a bank run to occur because the central bank had centralized all the bank reserves and would act as their lender of last resort. This makes the private banks much more profitable because now they can lend even more money that they do not have and charge interest on those loans. All banks in the central banking system would be driven by pseudo-market forces to the minimum reserve requirement because they will be less profitable if they do not expand as much as the other banks in the central banking system. Because all member banks are inflating at the same rate, this acts to significantly reduce the use of the interbank clearing mechanism. This is at the expense of the public, who gets lower interest rates on their savings, higher inflation, and a business cycle permeated by booms and busts. The next video that I'll do will be on this topic. In our example here, both the private banks are running on a 5% reserve ratio, and the central bank is running on a 100% reserve ratio. In the last video I produced, I showed you how when the American central bank was first started, it had 100% reserves, and then over time reduced that to a 40% reserve ratio, and then into a system where it required no reserves, to eventually the system we have today with not only no reserves but no gold in the system at all. I've just run through the inflationary effects of a central bank cutting the minimum reserve requirement of member banks, but I want to run through it of the central bank itself cutting its reserve ratio. In my last video I spoke about why a central bank would do this, mainly just to help prop up government spending, but it is a good idea to visualize the effects on the banking system here. We start with two private banks, both running on a 20% reserve ratio. We'll also introduce a central bank, which sits above both banks, and regulations prevent the private banks from issuing their own banknotes, so everyone has to use the banknotes of the central bank. And like we showed before, the central bank requires all member banks to centralize their reserves, so they all pull it towards the central bank, and the central bank provides them with a note. The central bank is running on a 100% reserve ratio because all the notes it has issued is 100% backed by specie. The central bank then reduces its required reserve ratio from 20% to 10%, and this causes the member banks to double their lending. The central bank mandates a minimum reserve ratio for member banks, as all banks will tend towards zero if they did not have a regulation in place to stop them from doing this, because of the moral hazard created by the central bank's existence. The existence of the central bank is a market intervention that necessitates increasing market interventions. Please note that the central bank is still running on 100% reserves because every note that the central bank has issued is still 100% backed by physical specie. If the central bank was to reduce its reserve ratio to 40%, what that would mean is that they would be issuing 2.5 times more notes than physical bullion they had in the vault. Private banks pyramid off the central bank's notes, and when the central bank pyramids off its own reserves, it causes private banks to issue more currency into circulation. I hope this visual example will help you to understand why I call the gold exchange standard a fake gold standard, and it also helps for you to understand that fractional reserve banking creates pressure for the central bank to reduce its own reserve ratio. The government and the banking industry have this in common because both like it when the central bank inflates the currency supply. The inflation resulting from the central bank not being on a classical gold standard, but rather on a gold exchange standard with a 40% reserve ratio, caused havoc for the markets. You can see this chart of the Dow Jones Industrial Average right before the Great Depression, how it skyrocketed as the monetary base was increasing. During the Great Depression, in 1933, President Franklin Delano Roosevelt made it illegal for American citizens to own physical gold bullion, and they're all required to hand it into the Federal Reserve Bank or the Federal Reserve banking members. When you handed in bullion, you got paid out for it at the current gold price, and then they did two things. The first thing they did was they changed the gold price from $20.67 an ounce to $35, so you got screwed if you handed in your gold and held onto the paper. And the second thing they did was they used their new gold reserves to issue notes against. So it was a way of increasing the currency supply while still maintaining a 40% reserve ratio backing the currency. To illustrate this, we have the member of the public who is forced to hand over his gold to the central bank. The central bank takes the physical specie and then uses it to issue notes against. It issues 2.5 times more notes to the member banks than the bullion it has in the vault. The member banks then take these new reserves and pyramids off them, so it creates even greater inflation in the system. At the end of World War II, the Americans set up the Bretton Woods system, and this system required the American central bank to hold no physical gold reserves, but rather honor their receipt notes at $35 per gold ounce. This led to the American central bank creating money like crazy, and obviously this was done to accommodate the massive government spending that was going on during the time. Gold ownership was still illegal for Americans, and this was to prevent a bank run on the central bank by American citizens redeeming their notes for physical gold specie. In my profession, I get a lot of pushback for recommending precious metal investments for my clients, so I just want to point this out. At the time, Warren Buffett's father, Howard Buffett, published an article demanding that the central bank allow for gold to be legalized and that gold should be redeemable by the American citizen. A week before recording this, I received an email from a colleague showing me how much Warren Buffett doesn't like investing in precious metals. He looked at me funny when I told him about his father, and he also didn't like it when I pointed out that Warren Buffett's company Berkshire Hathaway owned about a fifth of the world's silver supply before 2006, right before the GFC. Now, the Bretton Woods system was obviously unsustainable. Eventually, foreigners who were allowed to redeem their notes for gold did so, and then the whole system collapsed when the central bank experienced a bank run, and then they closed the gold window and would not pay out the gold for their notes. We are now in a complete fiat system with no precious metals involved at all, so I'll run through how that works now. We start off with two private banks running on a 20% reserve ratio with a central bank above them. The private banks pyramid off their reserves. The central bank pools all their resources to act as an intermediary between bank-to-bank lending and to act as a lender of last resort. The central bank can create currency out of nothing, so it creates another pyramid, and the private banks use the central bank's pyramid base as something to pyramid off against themselves. This entire process leads to greater and greater inflation, as there is now no longer any precious metal restraint in the system, and the central bank has the power to manipulate interest rates. Banks are in the business of selling loans. As the price of loans fall, the demand increases, and banks can lend more money and are likely to reach their minimum reserve ratios. This also increases the value of their collateral. I ran through this a little bit in my last video. When I showed interest rates going down, you could see bond prices going up, and off that, all asset prices going up. Rising rates reduces the demand for loans because it becomes more expensive, and it also lowers the value of bank collateral. As governments become increasingly more indebted and have trouble servicing their repayments, interest rates have been going lower and lower. When interest rates become negative, depositors quickly withdraw their money out of the banking system, and this causes a significant problem for the bank, as they are now much more likely to experience a bank run. I want to talk now about how the central bank actually manipulates interest rates. There's a couple of ways I've listed here. One I haven't listed is forward guidance, where they just talk about their intent of lowering or raising interest rates, and then off that, market forces actually cause the rates to change. The first one I've listed there is setting the minimum reserve ratio for member banks. So if we start off with two private banks running on a 20% reserve ratio, when the central bank cuts the minimum reserve requirement to be a member bank, they both make the adjustment, and this increases the amount of currency in circulation. As the supply of currency in circulation has increased, the price of renting it will fall, and hence interest rates will fall. I would like to discuss the money multiplier effect before we move on. In this video so far, I've been showing a bank with a 10% reserve ratio like this. However, I just want to demonstrate that this is not strictly true by going over the money multiplier effect. We'll start with this bank, which has $10 on deposit and is running on a 10% reserve ratio. The bank keeps $1 in reserves and lends out $9. Now the person who receives the loan can either spend the money and then that person puts it in another bank, or the person who borrows the money can deposit into a different bank himself. So the new bank receives $9 in total, but they're also running on a 10% reserve ratio. So what they do is that they keep a portion of it, 90 cents, and then they lend out $8.10. Then this person who receives the newly borrowed money spends it, and then the money ends up being deposited into another bank, and then that bank is also running on a 10% reserve ratio. So they keep 10% of the reserves on deposit, which is 81 cents, and then they end up lending out $7.29. Then this new loan ends up being deposited into another bank, and then this bank is also running on a 10% reserve ratio, so they keep just shy of 73 cents on deposit and lend out just over $6.56. The newly loaned money then ends up being deposited into another bank, and then this bank is also running on a 10% reserve ratio, so they keep just over 65 cents in reserves and lend out over $5.90. Now this process continues on. I'll spare you the calculation, but you can use the infinite geometric series formula to compute that after all the lending, the original $10 deposit will create $90 in loans. We can display it like this. Just note that I'm using $10 notes now instead of $1 notes. So we can see that for every $10 in the system, there has been $90 created by loans. The banking system also has a $10 liability, which was the original $10 deposit that they have to pay back to the person on demand. So I'll add that back into the pyramid. Earlier in this video, I just displayed fractional reserve lending like this to keep it visually simple and to assist in getting the message across. Now you have a better understanding of how it works, but I'll keep using it like this for the rest of the video just to keep things simple. To get your head around it, whenever I show a bank like this running on reserves, Just imagine that I'm actually taking into account the money multiplier, and I'm using the whole system as represented by the one bank. I hope that going through it like this further shows how fragile the banking system is, and demonstrates why banks are reliant on each other to remain operational, and this leads to a great moral hazard in the system and further cartelization. It should show how, when the government and the central banks say that everything is sound and that the banks pass their stress test, it is just propaganda to boost confidence and to prevent withdrawals. You can see why bankers hate and ridicule the gold standard, as it puts pressure on this system. The next way that the central bank manipulates interest rates is their payments on excess reserves. This is a fairly new way of manipulating interest rates that the Federal Reserve in the United States has. It was passed in the Financial Services Regulatory Relief Act of 2006, but it was meant to come into effect in 2011, but it was shoved through in October 1st, 2008 by the Emergency Economic Stabilization Act. Here the private banks are running on a 10% reserve ratio, and then one bank decides that it wants to have more reserves than what is required by the Federal Reserve. As a result of this, the central bank can make payments to the bank for its excess reserves in the form of interest payments. By changing the interest payments it pays to excessive reserves, the central bank can influence interest rates in the economy. The next way that central banks can manipulate interest rates is to set the interest rate for loans from the central bank to member banks. If a private bank extends too much credit and is at the risk of experiencing a bank run or falling below its minimum reserve requirement, it can then turn to the Fed and ask for a loan. And as it's the lender of last resort, the central bank will issue the loan, and the interest rate that it charges on the loan is known as either the interbank rate, the cash rate, the Fed's fund rate. Just depends on which country you're in, and it's a way of affecting interest rates in the economy on a broader scale. This is how private banks draw currency out of the central bank, and why the banking sector put pressure on the central bank to get off the classical gold standard and over time reduce its reserve ratio. Of course, in the current system we have now, there are no reserves, it's completely bogus. The money that the central bank lends out to private banks, it just creates out of nothing. That is why there is so much propaganda against going back onto a gold standard or any other monetary system where the banking expansion is limited, because it will lead to reduced profits for the banking industry and restrict government spending. Before I move on to the next one, I just want to point something out. As we've just discussed, a private bank can borrow money from the central bank at a certain interest rate, and it can get paid on excess reserves at a different interest rate. There can be times where the interest payments to the central bank for the borrowings is actually lower than the interest rate that the bank receives for excess reserves, so the private bank is actually getting money for nothing. The next way that the central bank manipulates interest rates is with the open market operations. This is the best way for the central bank to control the long end of the curve, which is just a fancy way of saying long-term interest rates. When you're lending money for a long period of time, you're subject to more risk because the chance of default is higher because you're lending for a longer period of time, and also there's the chance that inflation may erode your returns. That is why short-term interest rates and long-term interest rates can deviate quite dramatically. To understand open market operations, we'll start with the government, which sells the bond to the private bank. The government then takes the newly borrowed money and spends it. And just for the sake of argument, the government bond that was issued is yielding 20%, so the bearer of it gets paid $20,000 a year in interest. As part of its open market operations, the central bank decides to print money out of nothing and buy the bond from the bank. Banks and institutions that are able to sell bonds to the central bank are what's called primary dealers. They are a privileged group that are able to do this, and there are about 23 of them at the moment. To convince the primary dealer to part with their bond, the central bank has to pay them slightly more than what the market rate is, and that pushes up the price of the bond, and for our example, we'll say it's $105,263. Because the bond is still paying $20,000 a year, the interest rate is actually now 19%. This is the way that the central bank can affect interest rates on bonds. The bond goes and sits on the central bank's balance sheet, and the primary dealing private bank gets some newly created base money. The private bank then takes the newly created base money and then uses it to issue more loans against. This increases the supply of money in circulation and therefore can act to decrease interest rates because the price of renting money has fallen as the supply of money has increased. When the Federal Reserve was first created, it was actually illegal for them to purchase government bonds. This was because the leaders at the time did not want it to become a permanent source of government financing and allow government expenditure to increase significantly above tax revenues. Some economists argue that printing-based currency is not necessarily inflationary because the majority of currency in circulation is created through fractional reserve lending. This is not true because the banks will just pyramid off it as they account it as their reserves, and also it will lead to a greater moral hazard whereby banks are no longer afraid to issue more credit than they otherwise would be had they not had that backstop. In some countries, central banks are no longer just buying government debt, they're also buying the debt of corporations, as well as just buying into the stock market outright. When the Federal Reserve prints money to buy a government bond, it sits on its balance sheet, and you can see here where it's buying the listed number of US Treasury securities it owns, as well as the liabilities, the Federal Reserve notes in circulation. Of course, Federal Reserve notes in circulation are no longer a genuine liability, as the Federal Reserve defaulted on its obligation to pay gold on demand to the Federal Reserve notes bearer. Mainstream commentators say the Fed's insolvency does not matter. It matters when there's inflation and the central bank needs to sell government bonds to raise interest rates, but if they don't have any bonds to sell, then they are no longer able to raise interest rates through this mechanism. This is a chart of the Federal Reserve's balance sheet since the GFC, and you can see that they've been printing money to buy assets, mainly government bonds and mortgage-backed securities, through their quantitative easing programs 1, 2, and 3. You can see on the chart around 2018 the balance sheet started to shrink. This is when the central bank had started his quantitative tightening program, whereby they were selling bonds into the marketplace and sucking cash out of the economy. When the central bank sells a government bond, it raises long-term interest rates because the price of the bond falls as the new supply pushes the price down, but the payments are fixed, so the interest rate for the new buyers and the new borrowers increases. The private bank takes some of its base money and uses it to purchase the bond. The private bank now has less reserves to pyramid off, so the currency supply shrinks. This chart shows the yield on the 10-year Treasury, which is a proxy for long-term interest rates. You can see that around 2018 they broke above 3% for the first time in a long while, and the markets couldn't handle the higher interest rates. The S&P 500 fell about 20% when it broke above 3%. It didn't stop falling until the central bank came out and said that they were going to be patient with their interest rate hikes and also patient with their quantitative tightening program. I've spoken about how a central bank can lower interest rates, but I just want to go through a couple of examples of how they can raise interest rates. As I'm recording this, an American bank with more than $124.2 million in loans has to have a 10% reserve ratio for commercial loans. So if we have two private banks operating with a 10% reserve ratio, and then the central bank increases the reserve ratio to 20%, it will act to reduce the amount that the banks can lend, and therefore reduce the currency supply and push interest rates up. The next way a central bank can increase interest rates is to increase the interest rate it pays on excessive bank reserves. As I'm recording this, the American central bank is paying 2.35% in interest payments to private banks with excess reserves. As the central bank increases this number, it will actually cause private banks to reduce the amount that they lend and hold more in reserves because of the higher interest payments. This takes currency out of circulation and acts to increase interest rates. To pay a higher rate of interest on excess reserves, the central bank might have to print money. So this creates a funny situation where the central bank is actually printing money to stop inflation, and hence you can see why inflation can get out of control. The next way that the central bank controls interest rates is through the interbank rate, or the cash rate as we call it in Australia, or the Fed's funds rate over in America. It's the interest rate that a bank pays when they borrow money from the central bank. This can be either because they want to borrow money to lend out against, or if the bank gets called short. So if we have a bank in this example here, it has issued too much credit, and because of that it's falling below its reserve requirement, so it has to ask the central bank to extend a loan to it, and the interest rate that the central bank charges on this loan is how the central bank can affect interest rates. A higher interest rate causes private banks not to lend as much, or they'll pass the higher rates onto borrowers who may not want to borrow currency into existence at the higher rates. In the United States, the M2 money supply sits just shy of $15 trillion. M2 is the broad money supply after fractional reserve lending. The chart below that one is the currency component of M1. That's the currency in circulation, less the money you'd have in your wallet or in cash registers. When we take one from the other, we're left with about $13 trillion. This is a little bit concerning because vault cash, which is the bank reserves in the United States, only sits at about $75 billion. This means that the American banking system has about half a cent of reserves for every dollar it has on deposit. This figure also includes activities for investment banking, so it's not just commercial banking, which we saw that the reserve ratio requirement was 10%. Glass-Steagall was a law passed in the Great Depression. In the same year it became illegal for Americans to own gold bullion. It was designed to separate investment and commercial banking. This was repealed in the Clinton administration. This regulation is a little bit overblown by people who want it back because they think it's going to fix an unstable system. Generally, it's people who don't really understand how fractional reserve lending operates, and they don't understand that a central bank creates a moral hazard where banks are going to lend more money than they have on deposit. I view Glass-Steagall as a way of negating some of the damaging effects from previous bad regulation, but I don't think it's the solution in of itself. The solution is to get rid of the central bank and go back to a freer market in banking. Before we move on, I just want to reiterate that the American banking system has about half a cent on reserves for every dollar on deposit. So if we visualize this, it's a 0.58% reserve ratio, and from $1 of reserves, the private institutions can create $172 of loans. Fractional reserve lending makes people a little bit uncomfortable about putting their money in a bank, so governments create an insurance scheme where the state guarantees the deposits of each of these insured institutions. This further distorts the market as depositors no longer care about the soundness of the bank. However, there have been circumstances in modern history where bail-ins have been the primary way that banks recapitalize themselves. To illustrate how a bail-in works, we've got a depositor here who puts $2 into the bank, and the bank's running on a 20% reserve ratio, so it creates money out of nothing and lends it to the other man. Now we will pretend that the bank is experiencing a bank run, and for whatever reason the government and the central bank decide not to bail it out, so the bank is left with the only other option, which is to do a bail-in. The way it works is that the depositor no longer gets all their money back, and then the bank takes some ownership over some of the deposit. So here we'll just pretend that the bank takes half the depositor's money and uses it to recapitalize itself, so that when the person decides to withdraw some money, they're only able to take out 50% because they no longer own the whole lot. In some circumstances, when the bank is recapitalized, the depositor who lost out will also be issued with some bank equity or bank shares. It's important to note that the government guarantee of deposits only happens when the bank closes its doors and completely collapses, whereas a bail-in can occur right before the bank completely goes under, so technically the government doesn't have to guarantee the deposits up to the $250,000 mark. It's not really a true insurance scheme despite being framed that way. The government doesn't have the money to recapitalize all the banks, so it would have to print all the money to do it, and that can cause your currency to collapse relative to other currencies. At the end of the day, it just exists to create confidence. If you bailed in only people with $250,000 or less, you're going to get a lot of corporations where they've got huge working capital accounts who suddenly lose their money to the bank, and they're not going to be able to operate, which is just going to cause major problems for the economy. So the governments generally have the point where they go, okay, we're going to let the banking system close and reset, or we're going to print money and bail everybody out. Printing currency is usually the easier way out of this situation, and that's what we saw in the GFC when the American government and the American central bank printed money to bail out the banking system. Although inflation and bailouts are the norm, it's not always the case. In 2012 in Cyprus, 47.5% of deposits above 100,000 euros were forcibly converted into bank equity or shares. This was partially done because Cyprus is part of the Eurozone and they do not have their own central bank, and they did not have enough clout to get a bailout. In 2010 and 2014, G20 countries, of which Australia is a member of, agreed to an international bail-in regime that would address the risk posed by global systematically important banks. Then in 2018, the Australian Federal Parliament passed legislation and amended previous bills to give APRA, the Australian Prudent Regulatory Authority, the powers to order the conversion or write-off of capital or financial instruments during a financial crisis. However, they haven't defined what an instrument is. In New Zealand, they have the Open Bank Resolution, which is a policy aimed to allow distressed banks to be kept open for business while placing the cost of the bank failure on the bank shareholders and creditors rather than the taxpayers. It's important to remember that in the current system, depositors are unsecured lenders to a bank. You can be lower in the capital structure than other people. You should take care with the soundness of the bank before you place a deposit in it, but no one does their due diligence because of the government guarantee or the implied guarantee from the state and the central bank. New Zealand is making it a little bit easier to compare bank stability. They publish the information on banks every couple of months just so people can have a look at how risky they are behaving. Bail-ins in Australia are a little bit fuzzy. The law does not explicitly say what can and cannot be converted into bank equity. It appears that contracts have to explicitly say that deposits can be converted into equity, whilst major banks do not have clauses in their contracts with their depositors saying that they can convert their deposits into bank equity in the event of a bail-in. They do all have a clause saying that they can change the contract based on orders from the regulator or from the government. For your viewing pleasure, here are some excerpts from CBA, NAB, ANZ, and Westpac. In February in 2019, the International Monetary Fund, known as the IMF, released its report on the Australian financial system stability. In section 53, they said that more needs to be done to ensure that the authorities are well positioned to resolve a systematically important bank or to address a systematic banking crisis. It is explicitly stated that the IMF recommends that Australian lawmakers have very clear bail-in laws so that APRA has the clear power to do a bail-in so they can act quickly and prevent an Australian banking crisis from systematically harming the global banking system. Australian lawmakers may amend the law, but I think that the authorities want it to be a little bit vague to give them flexibility in a crisis, and they are hoping that any problems Australia potentially has are not caused from Australia and then exported overseas, but rather are imported from overseas, so lawmakers can say, oh, it's not our fault, we imported the problem from overseas. There is always the risk that having new bail-in laws will spook the market and set off a banking crisis. In the last few years, the war on cash has significantly increased in the West. In Australia, it will be illegal as of the 1st of July 2019 to make payments of over $10,000 in cash for any good or service. The government says that this is to stop money laundering, crime, and tax evasion, but it must not be forgotten that this has a significant impact on the banking system, as it now makes a bank run virtually impossible because depositors cannot withdraw large amounts of cash out of the bank and do things like purchase gold or silver bullion because it would be illegal to do it with an amount over $10,000 in cash. I don't see the $10,000 being increased with inflation. If anything, now that the government's got their foot in the door, the amount will be reduced. Governments and banks have never liked the use of cash. In America, there used to be a $1,000 note, but that was withdrawn from circulation. Now the largest common denomination note is the $100 bill. The reason being to prevent crime, to prevent tax evasion, but also to prevent bank runs through either the interbank clearing mechanism or from people able to make large withdrawals easily through large denomination banknotes. I've demonstrated the need for private banks to inflate together, but nations also need to do this to prevent runs on their currency. This is a major reason for something like the euro to have been created, because it allows banks to inflate together despite debt-ridden countries not being able to directly inflate out of a crisis. There is a push to create a world currency with a world central bank to create synchronized global inflation. This would allow central banks to increase the amount of inflation that they're able to get away with without being punished by the market in the form of inflation, their currency falling relative to other currencies, or the flow of precious metals from one nation to another. The system is very fragile. Initially, when the TARP bailout was first proposed to Congress, they voted against it because they had lots of members of the public calling up and saying, I'm underwater with my mortgage, where's my bailout? When Ben Bernanke, the then chairman of the Federal Reserve, met with officials from the Obama administration, he told them that if they did not bail out the banking system, the government better be ready to declare martial law because every bank would close and every credit card would not work. It is important to appreciate that the government manipulation of bank reserve ratios, interest rates, and base money has significant impacts on the economy and the standard of living of the people. The existence of a central bank makes the banking system less stable rather than more stable and exists to benefit the banking industry at the expense of the public. It does not exist as a result of the free market, but rather by privilege extowed upon the banking sector by the power of the state. Thanks for seeing this complex video to the end. I know it was difficult to follow everything. It was certainly very difficult to make. I hope you understand that a central bank is inherently inflationary, and being a public institution or a private institution with a government-granted monopoly does not change this fact. What I've covered here today won't be discussed at schools or universities, but I hope that it leads you to make wiser investment decisions. Thank you.